Hey everyone! In today's video, we're diving into a powerful trading strategy, the Supertrend Indicator, combined with filters for trend and ranging market conditions. We'll code the strategy in Python, optimize it using Freqtrade, and run thorough backtests to see how it performs across different market environments. Let's jump right in. Before we dive into the strategy, let's first break down the key indicators we'll be using in this strategy. Supertrend Indicator. The supertrend is a widely used trend-following indicator that provides straightforward signals based on price movement and volatility. It overlays a dynamic line on the price chart that changes direction based on the trend. At its core, supertrend uses the average true range to calculate its position and adjust for market volatility. This makes it more responsive to real-time price action compared to traditional moving averages. When the price closes above the supertrend line, it indicates a potential uptrend, signaling buy opportunities. Conversely, when the price falls below the supertrend line, it suggests a potential downtrend, signaling sell opportunities. What makes the supertrend especially useful is that it not only follows the trend, but also acts as a trailing stop loss, helping manage risk as the price moves. We can't rely on the supertrend alone. That's why we'll be using the exponential moving average as our trend filter. It acts as a dynamic support or resistance level, helping us stay on the right side of the market. When the price is above the 100 EMA, we consider the market to be in an uptrend and will only look for long positions. When the price is below, it signals a downtrend and will only take short positions. By combining the EMA with the supertrend, we align our trades with the dominant trend and avoid going against market momentum. Next, we also want to avoid trading in a ranging market, because this strategy works best during strong trends. To filter out sideways markets, we'll use two tools, ATR and ADX. In a ranging market, prices move sideways in a tight range. This means low volatility. To measure volatility, we'll use the ATR on a higher time frame. Even though we're trading on the 1-hour chart, we'll check ATR from the 4-hour chart for a bigger picture. When ATR is low, the market is likely quiet and ranging. When ATR is rising, it may signal that a new trend or breakout is starting. Instead of using a fixed number, we'll use an ATR quantile, like the 40th percentile, as a dynamic threshold. This way, our strategy adapts to changing market conditions. In short, we'll only enter trades when volatility is higher than usual compared to recent candles, helping us avoid choppy sideways markets. To make sure there's a strong trend, we also use the ADX, Average Directional Index. But instead of using a fixed value, we apply a dynamic ADX threshold. When ATR is high, we require a higher ADX to confirm a strong trend. When ATR is low, we allow a lower ADX threshold. This way, the ADX adjusts based on current market volatility. By combining dynamic ATR and ADX filters, we avoid entering trades during weak or ranging markets. Now that we've got our indicators in place, let's talk about how we actually analyze trends and generate trading signals. To enter a long trade, we need all of the following conditions to be true. First, the closing price must be above the supertrend line. This tells us the market is in an upward move. Second, the price should also be above the 100-period EMA, which confirms we're in a broader uptrend. Third, we check if the ATR on the higher time frame, in this case, the 4-hour chart, is above the dynamic ATR threshold. This helps us avoid low volatility, ranging conditions. And finally, we make sure the ADX is above the dynamic ADX threshold, which confirms that the trend is strong enough. Once all these conditions are met, we enter a long position on the next candle. For exiting the trade, we use the supertrend line as a trailing stop. If the price closes below the supertrend, we exit the trade and lock in our profits. In this case, everything lined up perfectly. And as you can see, it turned out to be a successful trade. Now let's take a look at short trades, where we profit from downward trends. To enter a short position, we flip our conditions. First, the closing price must be below the supertrend line. That tells us the market is in a bearish phase. Second, The price should also be below the 100-period EMA, confirming a broader downtrend. Third, we check that the ATR on the higher time frame is above the dynamic ATR threshold to make sure we're not entering during a quiet, ranging market. And finally, the ADX needs to be above the dynamic ADX threshold, so we know the trend has strength. Once all of these are met, we enter a short trade on the next candle. To exit, we do the same thing. We use the supertrend line as a trailing stop. If the price closes above the supertrend, we close the trade. Now that we've covered the strategy, let's dive into optimizing it for better performance using Freqtrade, a free open-source crypto trading bot built with Python. If you're interested in learning more about Freqtrade, be sure to check the link in the description for a complete Freqtrade course. Instead of optimizing once and hoping for the best, we rely on walk-forward analysis. This approach lets us continuously test the strategy on fresh, unseen market data as it evolves. By doing so, the strategy adapts over time, producing more reliable results and reducing the risk of overfitting. We'll focus on optimizing the following key parameters. Using Freqtrade's HyperOpt feature, the goal is to identify the optimal combination that maximizes profit while minimizing drawdown. Now let's look at the results. The strategy was tested on ARB, perpetual futures, using 13 months of out-of-sample data. It delivered a 184% cumulative return with a maximum drawdown of just 15%. Monthly returns ranged from -9% to plus 42%. And the strategy remained profitable in 8 out of 13 months. It executed an average of 3.1 trades per month, meaning the strategy stays selective, avoids overtrading. The maximum losing streak was 3 months, but the losses were relatively mild. The strategy also performed well on ADA, perpetual futures, delivering a 91% cumulative return with a maximum drawdown of only 11%, further confirming the robustness and consistency of the overall approach. Of course, backtest results don't guarantee future performance. If you want to explore this strategy further, we've made it accessible with full code, along with a complete Freqtrade and walk-forward analysis course that guides you through every step. I've left the link in the description below. If you found this video helpful, make sure to subscribe, hit the notification bell, and share it with anyone interested in quantitative trading.